Thanks very much, Sydney. Thanks for having us. We're thrilled to be back for I think that was the first Crowdfunding USA, the one in Atlanta.
Yes.
Okay,
It was
so
4 years ago. Yes.
I can't believe, after 4 years we're still.
Yeah.
Um, but
Thank you.
I guess that makes us pioneers, right?
Yes. And thank you. By the way, thank you for all of our sponsors that been supporting us. Without you, we wouldn't be here, including Sarah, yourself, Folio, and everybody I name it. And we have great sponsors. Thank you very much. Thanks, Brian, for participating.
Yeah, thank you. So it's my pleasure. We've been suffering through these conferences for the last 4 years, coast to coast, Las Vegas, and other places. And
The Silicon Valley, you were there.
that's right. So Silicon Valley, I didn't wear a tie, but I figured in Washington now I have to dress up and look more important. So also want to wish everyone a happy Star Wars Day. Today's May the 4th. And I'll introduce myself. I'm Brian Korn. I'm a partner at the law firm Manat Phelps. I am based in New York City. We have a national footprint in three main areas: financial services, entertainment, and healthcare. I'm the co-chair of the National Financial Services Practice and the chair of the Digital Finance Practice. We have over 100 clients that are engaged in some form of crowdfunding or online capital raising or fintech. And I have the next 10 minutes to talk about the very amorphous topic of spotlight on fintech, and hoping to not repeat what has already been said, but also not step on the toes of my future presenters as I look down the program. I'll give a little bit of a high-level overview and maybe focus more on the debt markets and what we're seeing. One thing that's interesting about fintech is that there really hasn't emerged a dominant player yet. In each of the various industries, it's still a fairly competitive landscape. You have many platforms that have emerged as sort of go-to places, but we don't have an Amazon, we don't have a Facebook, we don't have a very large tech player that has really entered the scene. I predict that at some point this year or next year, one of our big, what we call the FANG companies, the big tech companies, will make a splash in the fintech world by either partnering with existing technology or existing services firms, or starting their own platforms from scratch. The fintech universe is actually fairly fragmented. We have lending companies, we have crowd finance companies, we have payment technology firms, and all of them are sort of characterized by this notion of financial innovation. There's a famous quote from Henry Ford that he had after he had gone through and founded Ford Motor, that if he had asked the people what they wanted, they would have said faster horses. And it really is emblematic of what we're seeing with technology. A lot of people who are pioneers are doing so in a way where people don't quite understand what the impact's going to be until much later on in the process. We've seen that with companies like Google and Facebook, where they started out as innocent computer projects and have really turned into transformative technology. In the lending sector, we have over 100 companies that are actively lending money right now online that are not banks or affiliated with banks. The largest are in the U.S., Lending Club, Prosper, doing consumer loans. Small business lending includes firms like OnDeck and Kabbage, and smaller companies. In the real estate sector, you have companies like Share Estates, Realty Mogul, Lending Home, Patch of Land, that are really focused and dominating in that space. There are also subsectors of the lending world that are focused on by other companies. There's solar lending, medical payments, wedding finance, merchant cash advance, home buying. So there are companies out there that are transforming the home purchase market and the mortgage market. So instead of buying or renting a home, you will have soon a third option where you can lease to own your property, live in the property while you're renting it. Part of your payments are going to buy the house, and part of them are going out as rent. And that's to solve the problem of companies in competitive markets where you either won't qualify immediately for a mortgage because you have a thin credit file, or you are mobile and you want to be able to move from city to city or be transferred. And so we're seeing companies sort of step up to those challenges. In the payment space, we've seen a lot of innovation recently in the rent-to-own space. If you check out now at most of the national retailers, you'll have an option to finance your purchase, and you can, for even small purchases of $20 or less, you can spread those payments over a series of months. There are companies out there like Zibby that offer you a shopping budget on the rent-to-own space, and you'll be able to go out and actually finance larger purchases at companies and big box retailers like Sears. Retail installment contracts and rent-to-own are examples in the legal world of innovations that actually allow you to use and leverage the old legal infrastructure, which didn't really count those as lending transactions or loans, and therefore for these companies allow you to charge what might be an excessive or higher rate of interest than you can charge under state lending laws. We're seeing examples with rent-to-own and with retail installment and with merchant cash advance where there are effectively contracts for future payments that allow companies to negotiate through the legal landscape and really work their way through old laws that are generally designed to prevent abuses in lending practices but haven't quite caught up to new financial innovations. On the enforcement front, we're seeing regulation, and certainly what will be interesting is how the new administration will approach this. But the CFPB has started to become quite active and quite successful at going after the most egregious cases. We saw a case last year called CFPB versus Cash Call, where a lender was issued a cease and desist order and where they were using a tribal model to lend out at 134% interest. The company Cash Call was using the Cheyenne River Sioux tribe as their tribe, electing tribal choice of law, which apparently has no usury cap, and but all the operations were being done in San Francisco. All the collections work were being done by a U.S. bank and by collections people who were not part of the arm of a tribe. And so there's a lot of work right now within the tribal space, and there are tribes out there that are actual tribes that do lend out money and do charge a rate of interest that would exceed the usury cap in their respective state or jurisdiction. And there's this constant tension between the regulators and the tribes as to how much of it has to be on tribal land, how much of the technology has to be housed within the tribe, what percentage of employees have to be tribal members. Can the entire operation really be based in Kansas City and we can call it a tribal loan? So there's quite a bit in that area as well. We also see a lot of regulation by class action. Plaintiffs' lawyers have become very active in bringing cases for licensing violations, for usury. In the lending space, there are basically two types of action. One is you're not licensed to conduct this activity because we're disregarding the fact that you're using and partnering with a bank. That is called the true lender case. The other is that as you've purchased your loan back from a bank, you no longer have the right to charge the rate of interest that the bank charged. And there was a case last year called Madden versus Midland, which went up to the U.S. Supreme Court. The U.S. Supreme Court, which was down to 8 members after the death of Justice Scalia, denied cert, and therefore the ruling of the Second Circuit stood, which held that for the first time in 130 years, a financial instrument that passes into the hands of a non-bank can no longer charge the same rate of interest that had been charged when it was originated by the bank. That was a monumental step, not only in online lending world, but in the securitization world and other areas of the law where we have instruments pass into the hands of investors. What happened after that is that investors became very skittish about buying loans from Second Circuit states, New York, Connecticut, and Vermont, that were originated by banks and then resold. And so the lending market in those states dropped by 49% compared to other areas where it was noticeably higher. So we're seeing quite a bit of those issues. Madden has now gone down back to the district court in the Southern District of New York. A class action has been certified. The Delaware choice of law has been rejected, and they're going to apply New York law. And in the latest slate of bad news for Midland, they have their law firm has resigned, and they've added a new firm as of last week. So more to come on that case. We're seeing a lot in the worlds of bank partnerships. Manat and Merger Market did a study late last year, which is on our website, that shows that 84% of community and regional banks plan to partner with a fintech firm over the coming year. The numbers are similar when you ask fintech firms if they plan to partner with a bank. There are a lot of smaller community and regional banks that have not yet grasped the potential of technology and are still operating in a brick and mortar world. The number of banks, as you know, has halved from the Dodd-Frank Act and 2008 crisis to where we are now. And I think that where you're seeing the latest innovations in fintech are going to be matching banks with loan originators. Loan originators online. Somebody goes into a community bank, they generally have a personal relationship with that bank and that banker. The bank wants to say yes to the loan, but it may not be within their credit box. They can now source the loan through the crowd engine and find investors for that loan anywhere in the country, not just in their local area, not just through their own balance sheet. So that's going to level the playing field quite a bit, I think, and hopefully help small businesses and help community capital. With respect to regulation, it'll be interesting. The OCC has put forward standards for what they call a special purpose fintech charter. This will allow fintech firms to actually bypass banks altogether and become a special purpose bank themselves. The authority for whether the OCC can actually grant this is somewhat up for debate, and many people, including many of the state regulators in New York and California that have been the most vocal on this point, have claimed that OCC does not actually have the right to do this. The OCC came out with a release in January which stated that we do have the right to do this because if a fintech firm satisfies one of the three core banking functions, which are deposit taking, lending, or commercial transactions, then they do. Most of these firms would satisfy the lending component and don't have to take deposits, and therefore could sign up to be special purpose banks. The question, though, will be, what is the regulatory burden on a special purpose bank? Do you have to have the same capital ratios that full service banks have? Will there be FDIC regulation? Probably not, since you don't have to take deposits. And what is the relative benefit and cost of getting an OCC fintech charter versus partnering with a bank, going through state licensing processes, or finding ways throughout the laws and the regulations where you don't need a license altogether? So all those questions remain to be seen. The OCC, the control of the currency under President Obama was dismissed yesterday. Thomas Curry, his term expired April 9th. There is an interim OCC commissioner, and they're likely going to appoint a new commissioner to replace on a full-time basis. So whether fintech charters will move either under the acting commissioner or under the full-time commissioner is somewhat up for debate, and no one, I think, outside of the department really knows the answer. We've also seen the expansion of Reg A. Reg A was, if you read the regs and you go through the process, was really developed as a way of allowing companies that didn't want to do a fully registered S1 IPO to go public on a shorter form, less financial disclosure, less ongoing reporting requirements, and overall fewer operating costs. Reg A has actually blossomed, and where Reg A has been most successful is in the areas of fund formation. We've seen Fundrise now raise two $50 million funds. They're on their third fund, where they're effectively raising funds into a REIT that's going to manage and invest in real estate properties and fractional interest loans. And on the equity side, the uptake has been slightly slower. We've seen a few companies come out of Reg A. Elio Motors is the most notable, where they did a listing on OTC, and so that's another avenue. The big question is, if you don't go for the NASDAQ or New York listing after you come out of Reg A, what is your liquidity profile? Are you going to have enough traffic in the market? Are you going to trade frequently enough to offer your investors an aftermarket? A lot of people are excited about the prospect of raising money through Reg A or even through Reg CF, but the big unanswered question is, how do I get out of this? is there really a button I can push to sell this stock just as if I had a share of IBM and I can sell it onto the exchange? The third way we've seen Reg A being used, which is interesting, and Dara alluded to it with StreetShares, is it's become a bankless working capital line for a lot of companies. Companies are registering to sell their own notes through their own websites. In many cases, well, certainly under Reg A, you don't need your own broker-dealer, and a company like StreetShares has gone out and said, okay, we want to have non-accredited investors participate in our market. We want to have a way of raising money without going through bank or VC funds every month. And so you can go on now onto the StreetShares site, click Vet Small Business Loans, Small Business Bonds. You get a 5% fixed return. It is a recourse obligation of the company. It is not a payment-dependent note that's tied to any specific loan that they give out. And if you're a non-accredited investor and you know somebody who is raising money through or getting a loan through StreetShares, it is a way that they've developed to increase participation on their site from both the accredited and non-accredited community. The defense industry and the military industry, generally many are not accredited, and so they became wary of answering the phone and explaining the accredited investor thresholds, and somebody would throw their hands up and say, so I can go to war and save this person's life, but I can't invest in their loan because I don't have $1 million net worth or $200,000 of income. So I think there'll be more and more of these. If you look at it from the company's perspective, it's a way of raising money without going through a full bank process. You can flex the terms. You can have covenant light or no covenants. The bonds can be prepayable at any time. So it really gives you balance sheet flexibility and corporate finance flexibility, and it's all done through the public markets. The public essentially becomes your bank and your lender. So those are sort of the interesting ways. Reg CF is sort of the last unanswered question, and really what we're going to see is whether there'll be a legislative change to Reg CF. I don't want to say a fix, although people call it the Fixed Crowdfunding Act. But will there be a change to Reg CF that will encourage more capital raising through Reg CF? I've been to panels and forums and roundtables where one of the problems with Reg CF is that the disclosures and the quality of the information that's being given to investors has not been up to par with respect to what the SEC's expectation has been. And part of the problem with that is that the Reg CF rules limit you to raising $1 million. If it's your second capital raising and you're raising more than $500,000, you have to have an audit. It restricts your investors' ability to invest across all Reg CF platforms. It's one of the only regulations that actually cuts you off if you've already invested in a Reg CF deal from the next deal. And you have what we call IPO prospectus strict liability if you're a company. Whereas if you are doing a Reg D offering, or you're under this intent to defraud standard, which is a much harder standard to get sued on. Whereas in Reg CF land, similar to IPOs, if there's a material misstatement in the document, or if you more likely have a projection that you cannot fulfill, you are likely to get sued if you turn out a security that has diminished value. So that's kind of the landscape of fintech. We talked about payments, we talked about lending, enforcement, regulation. I think the states are going to continue to be very active, and I think that we're going to see more as the year progresses, but interesting times that we're living in. And I will turn it back over to Sydney.
Thank you very much.